I hope that you've all been enjoying the new online government finance statistics course so far and have been finding it stimulating. It's a great pleasure to be able to reach out to so many of you in so many different countries, over 170 at the last count, in this way. Now, what I want to do in this video is answer some of the course questions you have, and I'm pleased to see that so many of you have added questions to the discussion forum for me to answer. I'm going to do my best to answer your questions, but in this video, it's not going to be possible to respond fully to all questions received, so apologies if your question is one that I don't answer, but rest assured that I will be providing written responses to all questions on the Ask the Expert discussion forum. Okay, well, let's get started. Let's start with a question from George Kinkle, who asked me to explain the relationship between the statement of operations and the balance sheet. This is something very important to understand. We discuss it in Module 1 and keep coming back to it throughout the course in multiple modules. So in the statement of operations, we record transactions, and in the balance sheet, we record stocks. And linking these is a very important relationship. Opening balance sheet plus transactions plus other economic flows is equal to the closing balance sheet. And this relationship will always hold true. So let's illustrate this very simply. Imagine a government has $10,000 in bank deposits. So this is the opening balance sheet. They receive income of $1,000 during a quarter. For this example, it doesn't matter where this comes from. It could be taxes, could be interest, could be something else. But all else being equal, the closing balance sheet at the end of the quarter is $11,000. That's $10,000 plus the $1,000 in transaction equals our $11,000. So don't get confused here. The balance sheet records stocks, the $10,000 at the start of the quarter, $11,000 at the end of the quarter. And the transactions in the statement of operations are over a period of time. So that $1,000 increase in bank deposits, the transaction, could have been achieved in various ways. It could have been a single transaction in the quarter of $1,000 or multiple transactions which sum to $1,000 over the entire quarter. So this is the relationship between stocks and transactions. The relationship that I gave you, the opening balance sheet plus transactions plus other economic flows equals closing balance sheets. I do strongly suggest that you commit that to memory. This is what we describe as the horizontal integration in the integrated balance sheet. This moves me on to a question from Mark Wormuth. Mark asked, and I'm paraphrasing here, what is the difference between transactions and other economic flows? Why is a court order for a government unit to pay reparations to a householder considered a transaction where there's an event, well, this is an event outside the control of that government unit? So to answer this, I think we need to look back at Unit 1.7 in Module 1 at the definition of a transaction. A transaction is an economic flow that involves the interaction between two units by mutual agreement or through the operation of the law. So in the court example we've just looked at, the reparation payment is a transaction as it's through the operation of law and not because it's by mutual agreement. Now, although we often describe other economic flows as relating to unilateral events over which the unit has no control, such as holding gains, holding losses due to price changes or destruction of assets from natural disasters, the fuller and more technical definition of other economic flows is the changes in the volume or value of assets or liabilities that do not result from transactions. So it's just the order to try and make the classifications in as you decide on if something's a transaction or not. If it's a flow and it's not a transaction, then it's an other economic flow. Don't worry if you haven't fully followed the difference between the two. We'll talk about them a lot in modules 4 to 6. So there's a lot more of the course to come discussing the exact types of transactions that we record in GFS and indeed the type of other economic flows. I should perhaps warn you that there is one major transaction that doesn't meet the slightly simplified definition of a transaction I just gave you, and that is the consumption of fixed capital. I'm not going to say more about consumption of fixed capital here, as you're going to discover about this transaction in Module 5, but I just wanted to give you a heads up that the definition of transaction isn't quite as simple as I just described it. Let's move on to some practical questions now. One course participant asks, is it proper to compile GFS using audited statements? If yes, how do we go about it? The answer is yes. Audited statements are a great data source for government finance statistics, at least for annual government finance statistics, as audited statements are typically only available annually. Now, Module 7 will cover in some detail the practical approaches to compilation and how to use existing data sources to construct your government finance statistics. In the case of audited financial statements, you would typically construct something called a bridge table, where you map the information categories in the financial statements to the relevant GFS categories, and then use this to transform the data as part of your GFS compilation. And building an appropriate bridge table will take time. It can be resource intensive, as not all categories in financial statements can be directly mapped with adjustments, can be directly mapped to GFS, so you have to make some adjustments. But it certainly is worth the investment of that resource in building a good bridge table, because it'll help you automate the process of GFS compilation following that. So another course participant has asked a similar question, explaining that in their country, many local governments do not have a standardized classifier for fiscal accounts, or use different classifiers when compared to state and central governments. And they're asking, how should this be addressed? So I think what the question describes is a very common situation where different levels of government record their accounts and manage their budgets using different classifications. So I think the first thing to say is that in any country working to extend and improve their GFS, it's always advisable to first take a step back and ask yourselves, what do your GFS users need from the statistics? And based on these user priorities, you can start to design a prioritized plan of work. So how exactly are you going to extend your statistics? What are your the priorities for the improvements to your GFS? And it takes time to build up and improve your GFS. And so having this step-by-step prioritized plan is important. Again, Module 7 describes this approach in detail. So if I return to the question about local governments, if you're seeking to compile local government data, which is in a different format to central government data, then I think you've got a few options, one of which will be to build a bridge table, as we were just talking about, between the local government accounting data structure and the GFS categories. But this might not always be the best option. You're going to need to evaluate. For instance, if you have 200 local governments, all with different accounting systems and classifiers, then you're not likely to want to build 200 different bridge tables. And a better option in this environment might be to harmonize the accounting systems, at least across the different local governments that you have in your country. Moving on, a few of you have asked for some informational resources. One participant asked for a glossary of terms, another for a table showing the relationship between national accounts terms and codes and GFS ones. So here I'd like to point you towards the appendices in the GFSM 2014 manual. This is linked in the reference page of the course. And also linked, incidentally, in the reference page of the course is something called the GFS Compilation Guide for Developing Countries, which could be a useful resource for some of you who are asking about the practicalities of compilation. But going back to the GFSM 2014 manual and the appendices, Appendix 7 in this manual provides detailed information and tables showing how to translate between GFSM 2014 and the System of National Accounts 2008. And I trust you'll recall from the course that the accounting rules and conceptual building blocks in government finance statistics and national accounts are the same. So what differs is some of the terminology, the presentation, and some minor definitional differences. Appendix 9 in the GFSM 2014 provides a glossary of the GFS terms. So that was one of the other questions that I was asked. And you might also be interested in Appendix 8, which collects together the different GFS classifications that you will learn about in this course. And it presents them in a tabular format for quick and easy reference. Now I want to move on to consolidation. So quite a few questions on this topic in the forum. It's perhaps easiest to address these together through a few general remarks. The first thing to mention on this topic is that although we've introduced you to the concept in Module 2, you will revisit this topic again in Modules 6 and 7. So there is time to think more deeply about consolidation and hopefully to understand it better. The second thing I would say is don't worry too much about the terms intersectoral and intrasectoral consolidation and differentiating between them. We describe it in the course as it is. They are terms used in the GFS, but the principle of consolidation is the same. Whether it's intra or intersectoral, the principle is the same. It's a method of presenting statistics for a set of units or entities as if they constituted a single unit, by eliminating all flows and debtor-creditor relationships, the stock positions, among the units or entities being combined. So that's the textbook definition. And the reason we do consolidation is to make the statistics more comparable between countries. So in different countries, the institutional governmental arrangements nearly always differ. So the consolidation allows us to compare, say, general government in one country with general government in another country in an analytically useful way. Now, consolidation is not always easy to do for various practical reasons explained in Module 2. So it's always worth keeping in mind the analytical uses of the statistics you're producing and focusing your consolidation efforts on those flows and stocks that are most material. Also, as we say in Module 2, remember that balancing items of the consolidated sector should not be impacted by consolidation. And so if they are, you've made an error in consolidation and you need to review your consolidation methods, your consolidation calculations to find out what went wrong, because you should always be removing two equal flows or two equal stocks when you're doing consolidation in a symmetric way. Now, one course participant asked why in Unit 2.25 in Module 2, we wrote, there are significant specific issues related to the consolidation of financial institutional units with other types of units, which are outside the scope of this course. So what this sentence was flagging was that although you can consolidate financial public corporations with other public corporations or general government in exactly the same way as you can consolidate any other units, it may not always be analytically useful to do so. So for instance, in countries where there are large banks within the public sector, you might in consolidation lose a lot of analytically useful information on the structure of government financial liabilities, debt liabilities, and assets, because the holder of those instruments is the public sector bank. I'm not saying this is not necessarily a reason to do the full public sector consolidation, not at all. But perhaps in the case the example I described of where you've got large banks within the public sector, you might want to consider publishing both unconsolidated and consolidated data for the public sector, or consolidated data, but with supporting metadata to explain some of the consolidation that has occurred in the statistics, in particular relating to the stock positions and flows. There'll be various options open to you, but the important point here is that you should always ask yourself, what is the analytical value of the statistics that I'm producing? Before moving on, I should also mention that one of the other challenges that you may face when consolidating public financial corporations or potentially any public corporation, is a practical one of needing sufficiently disaggregated data to carry out the consolidation. And that data is not always easily available, particularly for financial corporations. Another area attracting a number of questions in the forum is sectorization, and in particular, the classification of particular types of entity. For example, there's one question from Svit about entrepreneur funds, and another participant asks about sovereign wealth funds. These types of questions are always difficult to answer in general terms. As to do sector classification properly, you need to collect specific and often detailed information about the entity being classified. And you need to look at the economic substance of the entity and not just the name of the entity. But the information that you require that's needed to follow the two decision trees presented in module 3. These decision trees are quite important, and if you follow them, then you'll be able to arrive at a sound sector classification decision. So the information that you gather is information to decide: is the entity a resident? Is the entity an institutional unit? Is the unit controlled by government? And is the unit a market producer? So as I say, if you're able to answer those questions, there's a fifth question about whether it's providing financial services, then you'll arrive at an appropriate sector classification decision, and one that you can evidence and you can explain to your users. In case of the specific questions I was asked about entrepreneur funds and sovereign wealth funds, it can be particularly important to satisfy yourselves as GFS compilers that the fund genuinely is an institutional unit. But that means it has operational autonomy separate from its parent, and so has the 4 characteristics of an institutional unit that we talk about in Unit 3.2 of the course. So often these funds can be just acting on the behest of of government, the parent unit within government, rather than genuinely having operational autonomy. So that's one thing to look at. But it's difficult, as I said at the outset, to say more than that. For more on the special cases, such as sovereign wealth funds, then I'd encourage you to read the PDF document in Unit 3.13, if of course you haven't already. Now there's another related question from Andre, pointing out correctly that international organizations are not residents of any national economy, even though they meet the criteria to be an institutional unit, and asking if this sector classification of international organizations is the same in other macroeconomic statistics. So the simple answer to this question is yes. The sector classification rules in the GFS are the same as those in the System of National Accounts. If I can expand a bit on the answer, I'd just like to emphasize that although the international organizations themselves are not classified in a national economy, their transactions and stock positions with national governments will be recorded in the GFS of those national governments. So for instance, loans from IMF to a national government, to a country, will appear in the balance sheets of those national governments, and transactions in those loans will be recorded in the statement of operations, and other economic flows will be similarly recorded in the GFS framework. One final very topical question from a course participant I'd like to address is how to record under the GFS the general government expenditures and international grants and aid that have been and are being provided to support businesses and households during the COVID-19 pandemic. So to help answer this question, I would recommend you go to the IMF website. I can't show you here in this video, but if you search for the special series on COVID-19, in there you'll find a statistical guidance note entitled COVID-19, How to Record Government Policy Interventions in Fiscal Statistics. It was published in April, and that title again is COVID-19, How to Record Government Policy Interventions in Fiscal Statistics. and that document gives advice on how to record in GFS government actions related to COVID-19. And it's important to make the point that this guidance note is fully based on the principles and concepts in the GFSM 2014, the same principles and concepts that you were learning about on this course. So with that, that's all from me for now. I hope you found this video useful. I apologize again to those of you whose questions I wasn't able to answer in this video, but I will, as I said earlier, provide some written responses. And we will continue with the Ask the Expert discussion forum, and so I'll be back at the end of Module 6 to answer more of your questions from the next 3 modules. So from me, it's bye for now.